Dear partners, over the decades, we have consistently emphasized one key principle at Berkshire Hathaway. Our investment decisions are not driven by excitement, news cycles, or fear. They are grounded in fundamental analysis, rational expectations, and a long-term mindset. The world changes, sentiment shifts, but value, true, durable value, does not vanish. It simply gets overlooked until it is recognized again. The purpose of this reflection is to take a sober look at 6 publicly traded companies currently held in Berkshire Hathaway's equity portfolio that have experienced significant price declines. As of the first quarter of 2025, many of these businesses are trading below historical averages, and in some cases even below their intrinsic value. That doesn't necessarily mean they are automatic buys, but it does mean they deserve our attention, scrutiny, and reflection on whether the market has become irrationally pessimistic. Now, let me be clear. A stock that has declined in price is not necessarily a bargain, but it is an invitation to look closer. And that is what I hope to do here. Examine each of these companies through the lens of long-term performance, growth potential, and margin of safety. Constellation Brands, STZ. The first business is Constellation Brands, a name many of you know from its premium alcoholic beverage portfolio. This company has seen its stock fall by 31% over the past year and 21% year to date. Over the last 10 years, it has returned just 50% to shareholders, significantly underperforming the S&P 500. But let's pause. Is the price decline justified? Or is this an instance where short-term thinking has mispriced a long-term asset? At current levels, STZ trades a forward P/E ratio of 13.5, well below its 5-year average of 20. Its dividend yield stands at 2.4%, above its historical average of 1.4%. Institutional ownership remains strong, with a slight edge in buying over selling in recent quarters. These are signs worth noting. But the weakness lies in growth. Flat revenue year over year, forward estimates at -1%, and expected EPS growth of only 1 to 2% over the next 3 to 5 years. That puts it behind both its sector peers and its own historical benchmarks. Still, value is not always found in high growth. It is often found in stability, brand equity, and investor discipline. At a projected intrinsic value of $213 and a current price suggesting a 15% margin of safety, it is neither a clear buy nor reason to sell, but it is a signal to watch closely. Domino's Pizza, DPZ. Next, we look at Domino's Pizza. Unlike Constellation Brands, Domino's has outperformed the market over the past decade, up nearly 290%. Though its stock is down 9% over the past year, it has rebounded slightly in 2025, up 8% year to date. This company has a long history of operational discipline. It's not flashy, but it is focused. The forward P/E is at 25, slightly below its 5-year average of 28, and the yield has increased to 1.54%, above its historical average. Growth projections are modest but steady. 5 to 6% revenue growth, 9% earnings growth, a bit below historical levels, but well within reasonable expectations for a mature consumer business. Intrinsic value estimates place the fair value at $497 per share, suggesting a margin of safety at 10% if purchased near $447. This is not a distressed asset. It is a business that remains healthy and may simply be experiencing a temporary dip. When institutions show increased buying at a time of pullback, as they have in Q1, that's worth noting. Before we continue, I want to ask you something. Have you ever considered what sets long-term investors apart from short-term traders? One key difference is how we view price declines, not with fear, but with curiosity. If you're finding value in this reflection, take a moment to subscribe, comment with your thoughts on STZ or DPZ, and share this with fellow investor. These conversations build the wisdom we all need. Let's not waste time. Here's the key insight up front. Warren Buffett believes tariffs are a hidden tax on the American people, and their long-term consequences can be more harmful than helpful. While many see tariffs as a display of national strength or economic retaliation, Buffett sees them as a silent penalty paid by consumers, manufacturers, and farmers alike. In a CBS interview, Buffett stated plainly that tariffs are an act of war. Though he later softened the phrasing, the message was unmistakable. Tariffs may be wrapped in patriotic rhetoric, But in practice, they distort markets and often backfire. He illustrated the domino effect vividly. When one country imposes tariffs, the other responds in kind, leading to a chain reaction that ultimately hurts everyone involved. This view aligns with Buffett's broader philosophy. Think not just about the event, but about what happens next. He challenges us to ask not, what's happening, but what are the second and third order effects? In the case of tariffs, particularly those aimed at China, the downstream effects are now unfolding in real time. One direct result is inflation. As tariffs increase the price of imported goods, manufacturers raise prices, consumers pay more, and purchasing power shrinks. But inflation is just one layer. Higher input costs reduce profit margins for American companies. Export markets dry up for farmers. Domestic industries lose competitiveness. And all of this happens under the radar of most consumers, who may not realize they're footing the bill. Buffett, known for his plain-spoken wisdom, used a quote from Will Rogers to drive the point home. We're the first nation in the world to go to the poorhouse in a nice automobile. That kind of irony is central to his view of misguided economic protectionism. It promises safety, but delivers struggle. Now, while this might sound like doom and gloom, Buffett doesn't leave us in despair. Quite the opposite. His answer lies in resilience and rational planning, not reactionary behavior. And for those managing their money or planning for retirement, this insight is gold. The market's reaction, more complex than you think. When the tariffs were first announced on April 2nd, the market dipped. That's not surprising. But here's what is. Since then, it has mostly recovered. As of this writing, the S&P 500 is up for the year. This rebound exposes a powerful truth. Markets don't move on facts. They move on interpretation. You could be right about the event, like predicting tariffs, and still be wrong about the outcome. Why? Because markets are complex, dynamic systems. They digest news in waves. What matters today might be irrelevant tomorrow. Buffett warns against trying to time the market based on short-term headlines. The volatility, he says, is noise. Painful, yes, but not necessarily meaningful for long-term investors. What matters is not being forced to sell when prices are low. Those who can stay the course through downturns often emerge stronger. That's why Buffett emphasizes one thing above all, your asset allocation. What percentage of your portfolio is in stocks? Bonds? Cash? Real estate? This mix should reflect not just your goals, but your temperament. A good allocation gives you peace of mind, so you can sleep at night even when the headlines scream panic. How to build long-term discipline. Buffett's advice isn't theoretical. It's rooted in decades of experience and success. He urges investors to set their allocation not based on emotion, but on two things, data and self-awareness. Two people might have the same income, same age, same financial goals, but their risk tolerance could be entirely different. That's why cookie-cutter strategies often fail. You need a plan tailored to who you are as a human being, not just who you are on paper. This is where a good financial advisor comes in. But not just any advisor, a fiduciary. One who charges hourly or by project, not one pushing products. They help you understand the trade-offs. How much to save, when to retire, what lifestyle to expect at different retirement ages, and what risks to take or avoid. But maybe you don't want to work with an advisor. That's okay too. Today, there are tools available for self-directed planning. One of Buffett's advocates recommends Bolden, formerly New Retirement, a platform that helps people create holistic financial roadmaps. These tools guide you through decisions that are otherwise easy to get wrong, especially when relying on spreadsheets and guesswork. The real cost of fast food. Now, let's look at a surprising consequence of economic trends. Even fast food is becoming unaffordable. 6 to 12 months ago, McDonald's quietly started losing its low-income customers. That's right, fast food, once the go-to for budget-conscious families, has now priced out the very demographic it relied on. Recently, McDonald's warned that even middle-income customers are starting to cut back. This isn't just about burgers. It's a signal, a sign that the consumer economy is tightening. And when consumers stop spending at places like McDonald's, it indicates a broader slowdown that can ripple through the market. So what do we call this? Some say it's a rolling recession, a staggered down and affecting different sectors at different times. Tech took the hit in 2022. Retail followed. Now fast food is feeling the squeeze. Buffett doesn't panic about such downturns. Instead, he sees them as natural parts of the cycle. He prepares for them, not by guessing when they'll come, but by making sure he's ready when they do. Interest rates, soft landings, and the role of the Fed. Meanwhile, interest rates have climbed, deliberately so. The Federal Reserve has worked to tame inflation by making borrowing more expensive. And while inflation has dropped from nearly 10% to just over 2%, this path has been anything but easy. Buffett knows the dance well. He's seen the Fed try to pull off the mythical soft landing, slowing the economy without causing a recession. Historically, this almost never works. Most of the time, rate hikes end in recession. But this time, the Fed has come remarkably close. That's no small feat, and while Jerome Powell is now a polarizing figure, Buffett respects the difficulty of his task. If Powell can pull this off, it will be a rare and impressive achievement. But the situation remains fragile, and tariffs could complicate everything. That's why Buffett returns, again and again, to the idea of having a plan, not a fantasy, not a wish, a real, grounded, adaptable plan. You need to know how much you're saving, what retirement looks like in 5, 10, 15 years, what trade-offs you're willing to make for lifestyle, flexibility, or security. Some people may choose to work longer, not because they have to, but because it allows for greater freedom later. Others may value their time more than money and choose to step away sooner. Neither choice is right or wrong. What matters is that it's made consciously. Health, mortality, and the purpose of money. One of Buffett's most powerful lessons is this. Money is a tool, not the goal. As you age, the trade-off between more money and more time becomes increasingly real. There's no point in delaying joy forever in the name of some abstract more. We don't live forever. Our health doesn't last forever. And no one on their deathbed wishes they had worked a little longer to buy another car. That's why Buffett's discipline is not just financial. It's philosophical. He sees investing as a way to amplify freedom, not as a game of hoarding or conquest. So whether you're 35 or 65, ask yourself, what's the money for? Adventure? Security? Legacy? Knowing this answer clarifies the trade-offs and gives your strategy meaning. And if you've read this far, you're clearly not just skimming headlines. You're someone who values clarity, truth, and long-term thinking. You're the reason this message was created. By the way, many people who enjoy these reflections haven't subscribed yet. If that's you, now's a great time to check and make sure you're subscribed and have notifications turned on. That way, you'll always know when new, insightful content is available without the fluff, without the hype. We now turned one of the most iconic companies in the Berkshire Hathaway portfolio and arguably one of the most discussed among everyday consumers, Apple Incorporated, APL. Let's be candid. Apple is no longer the underdog innovator in a Silicon Valley garage. It is a global colossus with a $3 trillion market capitalization, a customer base spanning continents, and a product ecosystem that has reshaped how people communicate, work, and entertain themselves. But with that stature comes increased scrutiny. Over the past year, the stock has declined 12%, underperforming the broader market. Year to date, it has been nearly flat, bouncing within a narrow range. Some analysts argue Apple is fully valued. Others say it is past its growth phase. But in evaluating Apple, we must return to the fundamentals. Recurring revenue through services, pricing power through brand loyalty, and a management team that continues to allocate capital with measured confidence. Apple's forward PE sits at 28, modestly above its 5-year average, but arguably justified by its margins and services growth. Institutional buying remains steady, and its dividend yield of 0.55% is bolstered by a consistent share repurchase program. Revenue growth is forecasted at 3%, EPS at 5 to 6% over the next few years. Intrinsic value estimates vary, but our conservative modeling suggests a value of $175, meaning at current prices there is little to no margin of safety. So, why do we continue to hold it? Because value is not only a function of price, it's a function of resilience, trust, and proven performance. Few companies can weather volatility and maintain customer obsession like Apple can. That doesn't mean we would buy more at this level, but it does mean we hold with conviction. Paramount Global, PARA. Lastly, we address one of the most contrary names in a portfolio, Paramount Global. A legacy media company in a rapidly evolving streaming landscape, PARA has been through turmoil. Its stock is down more than 60% in the last 24 months. Most recently, it has dropped another 20% this year. This has been a humbling position, even for disciplined investors. At first glance, the numbers are bleak. Low growth, shrinking margins, increased debt. And yet, this is precisely where long-term investors must resist the urge to judge a company solely by its stock chart. Paramount owns content libraries worth billions, distribution assets unmatched by many of its rivals, and a brand portfolio that includes CBS, MTV, Nickelodeon, and Paramount Pictures. The challenge has been monetization in the face of cord-cutting and intense competition in the streaming wars. Its forward PE is a mere 6, and the dividend yield, prior to its recent reduction, was among the highest in the industry. Forecasts suggest flat to slightly negative growth, but potential merger or acquisition scenarios continue to circulate. If priced properly, its content assets alone could justify valuations higher than current market cap. We do not suggest blind optimism, but we do suggest that investors maintain intellectual flexibility. The worst-performing asset today may become the surprise rebounder tomorrow, especially when sentiment is this negative. In closing this review, I encourage you to consider what truly makes an investor successful over decades. It is not prediction. It is not perfection. It is patience. Patience backed by knowledge, grounded by history, and sharpened by inquiry. If you've reached this point, you are among the minority who seek wisdom over noise. Many who watch our videos regularly haven't subscribed yet. Perhaps you're one of them. Double-check that you're subscribed and that you've turned on notifications so you don't miss these deep dives. Because success in investing is not about reacting to every headline. It's about building perspective one layer at a time. Thank you for joining me on this reflection. Until next time, Warren has imagined additional reflections on Apple and PARA. Let's take a deeper dive into what makes Apple a continued pillar in the portfolio. Beyond the metrics, Apple has cultivated something rare, an ecosystem with such integration that switching costs are psychologically and practically high for consumers. From iPhone to Mac to iCloud to services, Apple's ability to weave its products into daily life has fortified its moat in a way few companies can emulate. Furthermore, the introduction of new AI tools and chips internally designed, such as the M series, is a sign that Apple is not sitting idle. It is future-proofing its empire. In the short term, growth may be modest, but long-term, the blend of ecosystem dominance, user loyalty, and technological vertical integration creates a compelling case for stability even in times of tech sector volatility. On the valuation front, it's true that Apple doesn't scream bargain, but sometimes quality justifies a premium. A company that generates over $100 billion in annual free cash flow can weather macro storms in a way few others can. Even more, Buffett's philosophy emphasizes the importance of brand as an intangible asset. Apple's brand equity is nearly unmatched. It commands attention, loyalty, and a premium that is almost immune to economic cycles. This makes it less of a stock and more of a cultural institution, a position of great strategic power. Turning again to Paramount Global, let's talk about what most investors overlook: the value of optionality. In distressed assets like PARA, there's always a chance, however small, that something transformational happens. A spinoff, a buyout, a shift in strategy. There are rumors of private equity circling. There's talk of strategic partnerships with tech giants who need content but lack heritage. PAR might seem like dead weight now, but history is filled with examples of fallen giants who were eventually acquired for their legacy, not their present. More importantly, Paramount continues to produce award-winning content. Its film studios remain a crown jewel in an era where intellectual property is everything. And when sentiment turns, as it always does, those who bought at maximum pessimism often find themselves holding gold. This is the core message. Value isn't only in the metrics. It's in the narrative, the possibility, the optionality. We stay humble. We stay curious. We stay exposed, not recklessly, but wisely. If this perspective helps sharpen your thinking, don't keep it to yourself. Pass it on to someone who might benefit from a more grounded, strategic lens in these uncertain markets. Also, take a moment to leave a comment below, sharing which company from this review resonated most with you and why. Conversations like these help us all learn and grow.